So for our capstone panel, as I mentioned at the break, we have a fairly provocative title. Will technology be the end of relationship lending? And for that, I will turn it over to our panel's moderator, Brian Sullivan from the FDIC.
Jim, thank you so much for having me back and being a part of this outstanding conference. So this is a podcast, so we'll do a little housekeeping, sort of a little podcasting housekeeping up front, and then we'll just dive right in. I told myself that I would not shamelessly plug the FDIC podcast when I came here, but look, I just did that. So, so let's just get into this right now. Welcome to a very special edition of the FDIC podcast, coming to you from the 10th Annual Community Banking Research Conference. As Jim mentioned, I'm Brian Sullivan with the Federal Deposit Insurance Corporation. Again this year, the Federal Reserve Bank of St. Louis, the Conference of State Bank Supervisors, and the FDIC are hosting bankers, academics, and regulators to talk about the state of community banking in this country. Today, we talk about two different banking models: old school relationship lending that so many of our nation's community banks are known for, and new school digital banking that has quickly become the way most people bank today. On the surface, at least, it would seem these two approaches to banking are polar opposites, one built on humanity, if you will, and the other on technology. So at the risk of being blunt, we do ask this provocative question: does technology spell the end of relationship lending, at least as we know it? We're joined by three people who span this spectrum. Greg Hayes is the President and Chief Operating Officer of Kish Bank, based in Bellevue, Pennsylvania. Kish Bank has been around since 1900, a bank very much in the mold of what everybody recognizes as a community bank with deep roots in their community. Nicole Lorch is the President and Chief Operating Officer of First Internet Bank of Indiana, a financial institution that was founded 23 years ago as an internet-based bank, a bank born to live entirely online. And Amanda Swoverland, Chief Compliance Officer at Unit, a financial technology company that builds relationships with community banks to offer financial products through digital platforms. So welcome to you all. Greg, if we can begin with you, your bank has been around now for more than a century. I guess that makes you the old school.
I guess it does. Thank you, and appreciate being here. It's a great conference. It's one I've attended many times. As a banker, it brings insight to things that we see researchers and regulators trying to achieve in the industry, but it's a partnership. And that partnership is something that the traditional, the old school community banking model finds very important. So for us, I'm fourth generation. We are a publicly held company. We're not privately owned by the family, but my great-grandfather created Kishogo-Quillis Valley National Bank out of the merger of two local community banks, single branch banks in a very small town of less than 1,000 people in central Pennsylvania. And we've grown over that 120 years to be about over $1.2 billion now in 5 counties, supporting commercial lending, mortgage lending, all the products that traditional relationship based community bank would offer in our communities. But we're very focused on how we're going to do that in the future, because the needs of the consumer, the needs of the small business owner are changing. And so we'll get to that provocative title here shortly, but it's an exciting time and there's a lot of heavy lifting to do. And being in our community is what has created our growth. It's what's driven us. It's who we are.
Mm-hmm. Nicole, the First Internet Bank of Indiana, as the name suggests, doesn't rely on the bank branch model at all.
That's true, we don't. We were launched in 1999. We are in the 5% that Mickey Bowman referenced yesterday of deposits that are derived entirely digitally. We were a pioneer and really changing the delivery or distribution system of banking when we launched in 1999. Within 90 days, we had customers in all 50 states. And today we bank customers coast to coast with an award-winning platform for consumer mortgage lending, consumer deposits, small banking deposits, and we're a top lender in the SBA space as well. We also have a variety of specialty finance lines, and we're doing that on a nationwide basis. I do believe that our success is due to our fusion of tech-driven self-service options, but we're blending that with personal service. We are laser focused on the customer experience and believe that relationships are the key to our success in attracting customers, but then going above and beyond, having deep customer empathy, that's what's going to help us retain, deepen those relationships.
Amanda, you may be the unicorn here. You've been a regulator, a community banker, now you're at a fintech. You've been around the horn.
Yeah, it's been exciting to be here and kind of back to my roots where I started with regulators. It has been a fun journey, and I think I get to do what I love, which is nerd out on compliance. I love compliance. I know everybody here does too. And I get to build it into a tech-first solution, and really make sure that compliance is very forward and built into any of the architecture that we do. So what does Unit do? And I think there's a lot of different definitions of fintech, but what we do is we are a system of record, right? We are a core type technology. We build a lot of compliance solutions, and compliance is built into our technology and the oversight programs that we can help our partner banks with. And really, at the end of the day, we're helping bring technology companies and brands and partnering them with banks and allowing them to meet each other. And this isn't anything that's necessarily new. How many of you have that airline card in your wallet, or the hotel branded card in your wallet? Really? It's that white labeling of products. So we have a platform where we can help bring banks and these technology companies together. And together, I think we'll get into the topic today of how that fits together.
Well, let's start with how we define relationship banking. In the past, at least, I always thought that this banking relationship required the human dimension. You know, the handshake, the signing of the papers, the bank branch. But are we redefining what relationship banking is in this digital age? We'll start with you, Anna.
Yeah, I think it is. But at the same time, I think that digital first banking is actually relationship banking. And one of the best examples that I can give of building that relationship is take an accounting software that a small business uses. Most small businesses will use some type of technology for their accounting, to pay their bills, to do their payroll, right? It is the core of running their business. And they have a lot of trust in that particular accounting software provider because it's helping them every single day. Well, that online account software could say, you know what, I want to give this small business a checking account. Well, we know they need a bank. Banks are who offers checking accounts. So they need to have a bank, and they need to find a way that they can partner with a bank now to do this. So when they go and they meet with banks, and the bank is going to own that account, they're going to own those customer relationships, they're going to do due diligence on that accounting software company, and they're going to do all of the things that they need to do. That bank now just accessed a marketplace and a relationship with that accounting software customer base that they never would have been able to access before. So there is really allowing banks to come and meet people at their place and where another trusted source is, versus people coming into the bank. So it's allowing new avenues of deeply trusted relationships to form with brands that are already trusted within the marketplace.
Mm-hmm.
I think that's a great point, Amanda, because so long banking was thought of as a place-based transaction. You had to go to a branch to do the transaction. Well, I also had to go to Blockbuster to rent a VHS tape, and I had to go to Barnes & Noble to buy a book, and I was taking the recommendation of that particular bookseller, right? But today I can get such better recommendations through online sources where thousands of readers who liked something that I like can come together to make a better, more personalized recommendation than that one individual. So I think what technology enables us to do is create stronger relationships by really pulling and aggregating all of that data in order to really personalize the experience.
Yeah. Greg, would you agree? I mean, I came into this thinking that maybe these two models are mutually exclusive. Would you agree, maybe, or not?
I completely agree. And as a traditional community bank, trying to break that old school mentality, if we can't do what these other organizations have proven can be successful, that we can take our very differentiated human personal relationship experience and do it digitally. If we don't figure out how to do that, we will be dinosaurs, right? But the idea that the physical goes away, I think is the big question for us, because there's always going to be, we serve everyone from the Amish to Penn State student, right? We're in Central PA in State College area, and that's a very broad segment of customers. You know, average age of our client is 58, and while we see most of our technology adoption in that older segment, and I'm sure Nicole can say the same thing. The physical need tends to be the underserved. It tends to be the folks who, we have a lot of folks who don't have a credit card. They only have a debit card. We have a lot of customers who are primarily, they only have one banking relationship, very rural parts of Pennsylvania and across our country. And so it will be a long time until the physical goes away. But if we don't figure out how to build the digital relationship experience in our traditional structure, we may not be there for our communities. We may not be there for those customers that don't have the kind of internet access, the ubiquity of services available in more urban areas. So,
how do we marry technology with the old school bank experience to preserve and maintain this relationship we have with the banks?
Well, I think right now, you think about what computers do really well. I mean, they can aggregate data, they can synthesize data, they can organize data, but they're binary. You know, it's on, off, it's black, it's white, it's right, it's left. And what people can do so beautifully, and AI will get us there, is work within a range of guidelines. So a computer may make a decision, but that's based on human parameters that were set. Take a look at a person who can take a look at a credit memo and say, okay, so I know that, you know, if we just ran these through a system that it might say no, decline the loan, but my gut tells me that this loan's going to work out. And we hear that. So I think people are still able, with care and compassion that computers cannot provide, to take a look at scenarios and make an estimate within a range of options. And that's still where there is a place for people, because money is emotional. I mean, your consumer who's getting a mortgage, that's the biggest purchase they've ever made in their lives. And your small business owner who needs a loan, they are chasing their passion. And so money is still very much about feelings, and that's where people come in.
But where does feeling come in with all these ones and zeros? Amanda, I mean, can we be emotionally attached to our app? I mean,
Yeah, I think it's twofold. I do agree that there still needs to be that human touch. I think people want to be able to pick up their phone and their app, and probably that app that they're using all the time that they trust. And they want to do quick transactions. They want to check their balances. They want to get quick access to credit. They want to have those types of things. But they also want to know at the end of the day if they have a question, because this is money. This is trust, right? That they can call somebody. And I don't think that there's a single partner that we work with that doesn't have some level of that connectivity.
There's still a human?
There's still a human that sits behind all of this. It's not, fintech is not a bunch of bots that are sitting behind this. These companies that are partnering with the banks, and you're gonna hear me keep saying this because the banks are just the critical piece of this, is their brand is so important to them, and their customer and that customer experience is so important to them, just like your customer experience of somebody walking into the branch any brand that's going to partner with a bank has that same level of care that they want to take. And so when somebody has an issue, they want to make sure they address it, because otherwise it's going to be a poor review out on out on the web somewhere. So I do think that there is that same brand loyalty and care that a branch would offer.
Well, let me throw this out then as a variation on the theme, but do any of you envision a future where a bank customer can get a mortgage or a small business loan without ever having to speak to a human or to go into a branch location? We talked about the handshake and the signing of the papers, but is that our future?
Well, sure. I mean, we've staked our business model on it. So we've built a process that will enable that to go online, shop for a mortgage rate, apply for the mortgage, get all the way to closing feasibly without ever talking to a human being. But the reality is people are not there yet. And so we have built behind that excellent customer service to support them at every step of the way. So I think it's conceivable that at some point we will be there. We're not there yet. And so in the meantime, it's about meeting the customer where they are in their journey.
Well, Greg, is this future terrifying to you?
No, because I feel that we're a capitalistic society, and there will always be people that have a need and have a preference. And there's going to be people who want to meet with someone. There's going to be people who want to talk to someone. And there's also going to be people who want 100% self-service. And that ability to meet people wherever, whenever, and however they want is going to be critical to success. And there's going to be niche players. The question will be, as the transition happens, as the evolution in the industry happens, and I'd love to see some research on this someday, but where are we going to land? What's going to be left? How much of the population really fits that segment that needs that in-person human touch, or even the over the phone, digital but human relationship? And how many are completely happy with and comfortable with and prefer the self-service, the no human intervention, unless there's an issue, of course.
Right.
And I think the model that we talk about, I think what Nicole has to represent and has built is the future, to be able to handle both, to be able to do the full self-service model, but also be able to establish the kinds of relationships and support for client needs that I know a segment of the population will continue to demand.
Right.
And Greg, just to double click into that, we actually just worked with Harris on a poll with small business owners, and 71% of the people that we surveyed said that they would be willing to try to get banking in a new way given the current economic environment. Mm-hmm. So I think that there is a hunger to look at things in a new way. And find banking products in a new way for that.
Well, the last 3 years have changed us, right? I mean, this conference was always in person, and I will say they've done a beautiful job of making it hybrid. I was watching yesterday from my home office, and I felt like I was here. And you think about, when I started my career at an internet bank in 1999, my mother thought I was absolutely nuts. And so now I've got her ordering groceries online and having them delivered to her house. I mean, over the last 3 years, we've had to change, we've had to adapt. And what that has done is it has pulled forward this digital demand for services that has forced us to become comfortable with things we didn't previously think were possible.
There's three things we in the traditional model need to be very aware of, and that is ease of use, fees, and the kind of communication and notification that automation and technology can provide. That those are going to be table stakes in the future. And if we can't do that with the human element, if I can't continue to provide the human relationship, the in-person relationship, competitive with the fees of a totally digital solution, that's where we'll see the threat. So it's not just about the technology, but it's also about the business model and the cost associated with maintaining that business model, the sustainability.
Right.
Well, here are three things that we've done to kind of marry technology with that in-person relationship. So one, consumer mortgage lending. We can use prompts now. If I know that you're looking for a rate of, well, something less than 7% would be nice. I get a notification as a lender of when that rate is available, and I can reach out to the borrower because they still like to know that there's an expert minding the store for them. Two, with AI, we're able to watch transactions on cards and look out for suspicious activity. I mean, we've stopped scams on customers' accounts because our systems identified something that was suspicious, and then we reached out to say, hey, is this really you? Three, if you go to our website, I mean, we have a call center. Many banks have a call center, and we don't have a lot of branch activities. So we built a page that shows in real time who's available and who's not, who might be on the phone. So if you called Will and you had a complicated IRA question that you started, but you needed to get some more information, you can call back and get Will. He has a personal phone number, and you can see in real time if he's on the phone or if he's available to take your call, so you don't have to start that over again. So those are just three tangible ways that we've used technology right now to help our customers with the personal experience.
And they built that from the ground up. It's really hard for us to build. We're trying to, but we've got a traditional mind, we've got old school mindset. But there are great partners out there to help us with it. And so it's going to be a big evolution for some of us. It was not easy to build for others, but we believe strongly that relationship is at the center of where we're going.
Let me pivot to sort of a more market-wide approach to this. Yesterday, FDIC Acting Chairman Gruenberg made a point to stress of just how important it is for the community bank's physical presence in communities. We've seen a steady decline in the number of, both banks and bank branches in this country. To give you a sense of some of the numbers, last March, the FDIC noted the total number of branch closures last year rose a record 3.7%. We lost more than 3,100 branch offices. And in the last decade, the United States has lost 18,000 branch offices. Are you all concerned that the bank branch model is, to use what Clayton referred to earlier, as an endangered species?
I'll start. I'm not. Our model going forward is that if we can find that sustainable business model that and our approach is we are opening branches. We just opened one, had a grand opening this week that I missed, unfortunately. And we're opening 4 more within the next 6 months. But we're talking about branches with one banker, one community banker. They are that face, that representative, that human relationship that connects back to the call center, that connects to the person on the chat, or connects to the mortgage banker or insurance agent or wealth management advisor, commercial, small business lender. They're in that community. And we opened a branch in a town of 700 people. It's supported by a video ATM transaction, so that banker doesn't have to do transactions. Full service banking, any transaction you can do at a full service branch through technology, back to a human located in a central location. Our communities have demonstrated a want for physical locations. We're trying to build the model that is, from a scalability standpoint, from an expense standpoint, from an overhead standpoint, able to be achieved. And so we think it is important to communities. We think that folks need it, but we also understand they have to have the digital access as well. And so it can't be one or the other for us, for our model.
Amanda, how about you? You come at it from the technological point of view, or?
Yeah, and I think that the critical piece of that is, are we getting access to financial products and services to everybody that needs them? Because there's going to be some people that just do not want to walk into a bank branch. They don't trust that bank for whatever reason. They may not even speak the same language, right? So how are we going to make sure that we, and I keep saying this, we're going to meet people where they're at to make sure they have access to financial products and services? I started my career writing CRA exams, right? And looking at the impact to serve low to moderate income individuals, small businesses, When we look at who our bank partners are in the companies that they're working with, are opening accounts for, they're hitting demographics that have been somewhat locked out of the normal system that we think about. So I really think that the movement and the evolution that we're seeing is going to allow for more access to credit. It must be done safe. It must be done responsibly. We're not, not in the business of charging aggressive fees and doing things. It has to be built with the right compliance framework around it. But I think it's going to increase access over time, which is in line with the mission that all of us, want to have in the marketplace is just to have fair and equitable financial access for everyone.
And Nicole, your bank was never a branch-based model, so this talk of endangered species, I don't know where you fall on that.
Well, I think to Greg's point and to Amanda's point, we need to make sure that our communities are being served, and First Internet Bank has always taken a very strong stance on that. But does it need to be a branch, or does it need to be service to the customer? And so I think the idea of what a customer needs is truly evolving to the point of ATM connections or video connections back to the home office, ATMs that will dispense coin as well as currency to the penny. So you don't have to have a human being at a teller dispensing that amount of money. We have more customers who are more than a day's drive away from our branch or our headquarters location than we do those who are within it. And it's more than just the 9 to 5. But the famous quote, of course, is Henry Ford saying, "Well, if I had asked customers what they want, they would have said a faster horse." So it's not so much, what our customers saying they need, but what is really being done. If banking has become an errand and not a value-added service, then maybe we need to think about what's taking place in that branch.
Before we got talking, Greg, you likened it to the travel industry a bit.
I did. When you think back, even the advent of the internet, travel was kind of the first disruption of industry in that Expedia and all of the different very internet-based travel planning solutions came out. And now you see this large shift, especially coming out of COVID, this resurgence to travel and the use of travel agents and the highly profitable, highly successful travel agencies out there that are bringing the kind of experience that people demand, that people want, that they just can't get on their own. You've got dual income families, both parents are working, kids doing a lot of things. You can't plan that trip of a lifetime without a consultative advisor. You can't buy that house, that huge purchase that you're going through, or start your business without resources and support. And in the travel agency business, they've realized you don't have to be physically located. You don't need to have that storefront. There are travel agents in California supporting my customers in Pennsylvania all the time because technology has allowed it. And so the relationship need hasn't gone away, but technology has certainly escalated and increased the availability of those services and that personal relationship.
Yeah. Let's pivot to what the implications to access to credit are with all this movement toward technology, especially for minority borrowers and low to moderate income communities. We heard some outstanding research presented here and yesterday's conversations that focused on how minority loan officers were less reliant on the sort of traditional underwriting, debt-to-income ratios and credit scores and the like, and applying so-called soft information to make their credit decisions for borrowers some might sort of on the surface think are somewhat less than creditworthy, but in the end, these loan officers saw lower default rates. So I ask for all of us to consider here, is there a danger here that with a more technological approach to banking and to lending that somehow we might fall short in reaching certain borrowers who have proven to be good credit risks?
I don't think so at all. I think that when you take the learnings from that and you can combine that with technology, you can actually reach more people. You don't have to you don't have to lose some of those nuances.
More is more?
More is more. It's not a zero-sum game. You know, there's plenty of different ways to reach different people, and again meet them where they're at. So I don't think so.
So, Nicole, it's probably an unfair question to put it to you right here in this public setting, but without the ability to look somebody in the eye and to understand their sort of personal circumstances, how does that impact your credit decisions?
Well, we've been able to partner with CDFIs, for instance, to create products that are innovative and responsive to the needs of our community. And so by making those partnerships, and this is what Amanda does all day, every day, right, is forging partnerships and relationships. So you get that on-the-ground expertise with the marriage of technology and access to capital. And I think that can make us even more powerful as a combined agent. And at the same time, we're able to use technology to screen applications in a way that is fair and consistent as we're looking at them.
And Greg, do you feel like anything's been lost by not having that person on the other side of the table or that handshake at the end of the transaction?
I think there's tremendous value in having human intervention when needed, but technology absolutely increases the accessibility of credit as long as that segment has accessibility to technology. And where that's not prevalent, we need to have physical and human ability to deliver credit to those segments. But technology has absolutely kind of expanded the approach. You know, just because credit scores have been around forever and have been the mainstay of how we determine credit decisioning in traditional banking, it is not the future, and it is not flawless. There are certainly things that are broken in the credit reporting system and approach to having that be the only factor in determining availability of credit. And so the capability of data, utilization of data, and the technology available, and many of the fintech startups out there in the lending space have given banks the ability to say yes in times where they couldn't before. And the engagement with regulatory agencies and specifically with regulators when we meet in person and get to talk through how we're doing things and how we're engaging with partners is really allowing banks to bring more services to more people and in better ways, more efficiently, more effectively, at lower costs. It's a rising tide that is lifting all boats.
And it's early innings. I mean, if you look at a timeline of financial services technology from, when currency was created until present day, there was this really long lag in the middle where not much happened. And we're seeing an acceleration now. So I think it's in some ways even too soon to say where this will land because we're already doing things that we never thought we would do before. I have a digital assistant in my kitchen that on command will tell me a joke, and its feelings are not hurt if I do not laugh. So I think that there's a long way to go here. And
you command your technology to make you laugh?
Well, I'm sometimes short of a dad joke when I'm asked for one, so I have a go-to, but my daughter's heard that 18 times, so.
So Amanda, you engage with community banks. Are they at all resistant to this wave of technology that the marketplace is really demanding of them?
I think we're seeing more and more banks wanting to enter into this particular space. So I'm sure there is some resistance.
How you're a compliance person. How does technology ensure that a banker really knows their customer?
Oh, I don't have enough time. Honestly, I think in a lot of ways, technology can give you more assurance that you know who that person is than somebody who's just sitting in front of you. The level of identification we're able to do online, even without them uploading a driver's license, is phenomenal. You can pinpoint to exactly where that person is when they're applying for a loan. The fingerprint of that device, have we seen that fingerprint show up in other places to detect fraud? I think in a lot of ways, what we see online can be more safe and secure than even in person, based on the amount of information that you can pull in to those.
So you don't have a problem with the whole safety and soundness of the banking world, You know, it's more safe and more sound after all of this?
I think it is. I think there's more transparency into the system of where we're evolving to, and the amount of information that we're able to look at. Right? If we're exchanging a $20 bill, I just lost visibility where that $20 went to. But when it's all digital, it's traced, and we know exactly. We can tell the device it came from, the IP address that it came from. When you talk about detecting fraud rings and finding and preventing, right? My big thing is, let's not even let the bad guys into the ecosystem. Let's build really strong account opening processes to make sure we don't even let them in to be able to transact for that. I think that technology actually enhances that dramatically compared to some of the in-person experiences that you can have.
Old school, new school, do we agree here?
Absolutely.
Okay. Well, with all this need really to adopt technology in this digital banking world of ours, still is there this risk of losing the human dimension, though? And you say that there are people at the other end, but people cost money, and technology costs money, a lot of money. Still, is there any inherent risk toward this wave that we're riding here?
Well, there's always risk in everything we do.
Yeah, you're in a risk business.
Risk
right?
business. To me, it's how we manage it. It's how we develop our products and services. It's how bank partners that are in this space manage it and oversee it. And walking into it eyes wide open, right? Of just knowing that there's an evolution that's happening, and we need to be prepared to think about the risks. Banks need to develop their risk appetite statements. They need to know what, do they want to deal with consumers? Do they want to deal with businesses? Which niches do they want to enter into?
Yeah, you're still going to have that examiner coming into your
Yeah.
office asking those questions,
Yeah,
right?
so you need to be prepared for that. But the value that a partnership in conjunction with a traditional bank model. Many of our partner banks have branches, and they have trust companies and different elements that go along with it, and they serve their local communities. But they really want to begin to serve more, and so they work through partnerships to be able to offer those products and services. It grows their deposits, it grows their revenues. Now they have more deposits, they can turn around and they can lend back into their communities. They can keep a branch open, right? Mm-hmm. Because they have these new revenue sources and new sources of deposits. So we really take the model of it can all exist together, and it's not really competition. There's a need for all of it.
Well,
Really?
if I'm sorry, go ahead, Greg.
I just wanted to say that it's not technology that is kind of the threat to human interaction and relationship. Technology is the future of human interaction and relationship. The real threat is the loss of competition, the loss of choice. I have said it at this exact conference, not this specific conference, but this conference a couple of years ago. My wife's family's from Ireland, and there's 5 banks, now 3 banks in Ireland over the past couple of years. There's no choice. The independent banking system in the United States is the foundation for everything that can be achieved, everything that we hold dear, and that's the threat. It's not the technology. From a regulatory standpoint, from a compliance standpoint, we need to figure out how these technologies help us continue to grow and provide the access to choice, the access to services that people demand, and expand it into communities that need service. So I just wanted to make that point because I think it's really critical. Technology is how we'll get there, not what's going to ruin it.
I would agree, and I'm sorry, Brian, this panel's probably been more common ground than Jerry Springer, even though we tried with a provocative title. But people can dream, people can imagine, people can innovate, and computers can execute. And so I agree with both my fellow panelists here that there's a place for all of it.
Well, you, Nicole, had likened this marriage between technology and humanity. Is this a marriage made in heaven? Is this what I'm hearing? I mean, speak now or forever hold your peace. Greg, we'll begin with you and work our way down. We have about 5 minutes.
I would say yes. I can't figure it out. Traditional banking mindset, mentality, my leadership team, we can't build what Nicole's team has built. But if Amanda and the team at Unit could help with this marriage, I think that the capability to bring the traditional physical relationship and the technology relationship capabilities together can sustain community banking as we know it in a very different future. And it's exciting. It really is. So I will forever hold my peace on that.
I think it is. It's a marriage, and of course, we all say to err is human, and to screw up really, or to really screw up takes a computer. But again, that's humans behind the computer. The problem exists between keyboard and chair, is the PEBCAC rule that we use in IT. There's a place for all of this. I mean, we were talking before the session about, Greg has millennials who only use cash. We don't have that customer because we're not built for that customer. And so I think what the beauty of this is there's a place for both of that, and companies like Unit are helping to bring those two together.
Clearly, I think Kevin kind of staked my career on it. Yeah, it's really fun for me to. I started my career examining community banks, working at community banks, and now I partner with community banks. And it's been really fun for me to watch the evolution of that, and really what we've been able to do to, at the end of the day, help the end customers.
Well, if our question was, will technology spell the end of relationship banking as we know it, I guess that is a no across the board here?
Hard no.
Only making it stronger.
Yeah. No.
Well, okay. Well, I'd like to thank Greg Hayes, President and CEO of Kish Bank, and Nicole Lorch, President and Chief Operating Officer of First Internet Bank of Indiana, and Amanda Swoverland, Chief Compliance Officer at Unit. Thank you so much for joining us on the FDIC podcast.
Thank you, Brian.
Thank you.
Thank all of you.
Giving you back 3 minutes and 27 seconds.
Hey, Brian, and we had a question come in, and I know the podcast is now over. You put the end on it, and we have a few minutes here before we go to our final wrap-up session. And just to acknowledge a question that came in from our online audience, and this is for Greg, Nicole, and Amanda. So the question was, would the panel agree that what defines relationship banking is allowing the customer to make choice? I think you got to that, Greg. In contrast to large banks who force customers toward technology, community banks offer the option. Technology when you want it, people when you don't. So this comes from one of our online participants, and so let me turn that over to you.
Connect me with that person.
Yeah, we're living in a hybrid world these days, and I think that's a really good way to put it. Technology when you want it, and people when you need them.
Yeah, community banks are they're very nimble. They move fast. They're very innovative in what they do. They're not hard. You can just be nimble, and I think that's why they're great partners for us.
The hard part is over 57% of the population consumer population is banking with one of those big five banks. The hope is that they figure out that they have choice, that they understand that community banks can bring things that they're not getting today. And that's really the hard part that we struggle with is getting that message out, that we have all the technology and capabilities of the big banks, but we're going to bring differentiating capabilities that they don't bring. Thank you for the question.
Please, we have some questions.
Looks like we have.
Thanks very much. I really enjoyed this panel. It's great to see everybody so optimistic. So I have some optimistic comments also. So it's a great question. And actually, we have some research that actually gives some answers on this. So let me break down the question into 3 questions about this ending relationship lending. One is, can technology essentially replace relationship lending? Does fintech essentially hard and soft information. Can its machine learning figure out from your phone records and all these other things, can they figure out relationship lending? And we actually have an answer from the research, and the answer is no. The answer is that what we see is fintech firms more replace the lending of the big banks than the small banks, and we can kind of infer from that is sort of using the hard information better and not the soft information. So we kind of have the answer to that. Mm-hmm. Second question would be, and I have a paper on that on SSRN 2022. Go ahead and download it for yourself. Second question is, can these relationship lenders cooperate with fintech and other technologies? And the answer there is yes. I think it's pretty obvious that banks, community banks, can use technology along with relationship lending. You use your relationships to find the customers you want to lend to, and have fintech figure out some things for you. They can do your mobile wallet for you. They can do the credit score for whatever it is. And we see already the success that works. And third question is, what should community banks do? And the answer is it's the same thing from 250 years ago in banking, in economics. It's always the same thing. You do what you have a comparative advantage in doing. Always do that. Do your niche. So do the relationships, and do that very well if that's your niche. And then whether we're going to use the technology, but whether it's you cooperate with a fintech or you provide technology stuff, it's kind of a secondary question. Yes, you can do either one. Whichever one's cheaper than that, but focus on the relationship part of it. That's what you do best. Don't focus on technology. If you can do it cheaper yourself, you do it yourself. If fintech can do it cheaper for you, you cooperate with them. What's the difference? That's not the important part. Do the part you can do best. So that's all from research. You guys know the banking. I know the research. So.
All right, well, we are at time, so please join me in thanking our panel. Thanks to Brian Sullivan, the FDIC, and please tune into the FDIC podcast. And, of course, thanks to Greg, Nicole, and Amanda.